Today we will take a deep dive into why clustering as long-term and defensive investor might have gone a little too far, and why Buffett's latest move signals a highly valued stock market. Along the way, we will sprinkle in a few comparisons between recently overvalued stocks and past market excesses. Over the past 12 months, the S&P 500 has had a bumpy ride. It started out fairly flat, gaining about 3% from January to mid-February, only to drop by 19% from mid-February to early April, before rebounding 38% from April's lows. That resulted in an annual gain of 17%, a decent year compared to recent history. 23% in 2024, 24% in 2023, and negative 19% in 2022. So why are prominent value investors like Warren Buffett or his successor Greg Abel holding more cash these days? To answer that, we first need to understand the term narrow market breadth, a situation only a few highly valued stocks drive most of the market's performance. Looking at the S&P 500's current breadth, we see a massive shift in recent years. Back in 2000, the top 20 companies represented about 37% of the index. Over the following decade, this share declined year after year, bottoming out in 2015 at 27.6%. From 2016 onward, however, the top 20 stocks started to represent a growing share of the total market, recently surpassing an astonishing and risky 50%. In short, 10 years ago, the top 20 companies made up about a quarter of the S&P 500. Today, they account for half of it. Another way to visualize this is to reverse the metric, looking at how many companies together made up 50% of the S&P 500 in each year. Unsurprisingly, we see the same pattern. In 2000, it took 38 companies to reach 50%, rising steadily to 58 in 2014, before shrinking to 37 in 2023, and then dropping further to just 20 today. Another indicator of market saturation is the current S&P 500's price-to-earnings ratio, which sits around 30. In other words, you're currently paying $30 for each dollar of earnings, unless prices keep rising significantly. For long-term defensive investors, that ratio leans more towards speculation than investing, as it isn't based on reliable fundamentals like past earnings and sustainable growth. That's one of the key reasons why legendary value investors find few, if any, true bargains today. Instead, several prominent names like Berkshire Hathaway are hoarding cash, waiting for a market correction before stepping in. For private investors, timing the market remains one of the hardest things to get right. As star fund manager Peter Lynch once said, far more money has been lost by investors trying to anticipate corrections or time the market than has been lost in the correction themselves. Still, a cautious investor should hold around 20% to 25% of their capital in cash. As defensive investor, we stay fearful when others are greedy and greedy when others are fearful. Rather than selling in fear, we think long-term. As buy and hold investors, we patiently build up a 20 to 25% cash position from our regular income, ready to act decisively yet humbly when panic hits the market. Thanks for watching and see you in the next one.